Continuation of Chapter 7, Planning, Section 2.4, Control Risk. Control risk is the risk that a misstatement would not be prevented or detected by the internal control system that the client has in operation. In preparing an audit plan, the auditor needs to make an assessment of control risk for different areas of the audit. Evidence about control risk can be obtained through tests of control for each of the major transaction cycles. The initial assumption should be that control risk is very high and that existing internal controls are insufficient to prevent the risk of material misstatement. However, tests of control may provide sufficient evidence to justify a reduction in the estimated control risk for the purpose of audit planning. It is unlikely that control risk will be zero because of the inherent limitation of any internal control system. Note: control risk can be reduced by introducing new controls or better controls. However, the design and implementation of controls is the responsibility of the management of the company. Management may introduce better controls to reduce the control risk in next year's audit, perhaps in the recommendation of the auditors, but control risk cannot be reduced for the current year's audit. Section 2.5, Detection Risk. Detection risk is the risk that the audit testing procedures will fail to detect a misstatement in a transaction or in an account balance. For example, if detection risk is 10%, this means that there is a 10% probability that the audit test will fail to detect a material misstatement. Detection risk can be lowered by carrying out more tests in the audit. For example, to reduce the detection risk from 10% to 5%, the auditor should carry out more tests. In preparing an audit plan, the auditor will usually set an overall level of audit risk which he judges to be acceptable for the particular audit. 2. Assess the level of inherent risk and control risk, and then 3. Adjust the level of detection risk in order to achieve the overall required level of risk in the audit. In other words, the detection risk can be managed by the auditor in order to control the overall audit risk. As noted above, inherent risk cannot be controlled because it operates independently of controls. Control risk can be reduced by improving the quality of internal controls. However, recommendations to the client about improvement in its internal control can only affect control risk in the future, not control risk for the financial period that is subject to audit. Audit risk can be reduced by increasing testing and reducing detection risk. Section 2.6, Audit Risk Assessment, a summary. The implications of this approach for the audit work can be summarized as follows. We have a diagram here. In the first box, we have to achieve a target level of audit risk. If inherent risk multiplied by the control risk is high, then our detection risk must be low. High level of audit testing is required. Larger sample sizes. To achieve a target level of audit risk, if inherent risk and control risk is low, detection risk must be high. Lower level of audit testing, smaller sample sizes. then issue audit reports. In the left-hand column, the auditor needs to achieve a low detection risk to compensate for the high inherent risk and control risk. This is likely to require extended testing and hence larger sample size. In the right-hand column, the auditor is comfortable to accept high detection risk because they have assessed inherent risk and control risk to be low. In this case, they are unlikely to need to extend testing significantly and hence can adopt smaller sample sizes. Section 2.7. The connection between business risk, financial statement risk, and audit risk. It is important to understand the connection between business risk, financial statement risk, and audit risk. The connection between business risk and financial statement risk was mentioned in a previous chapter. The connection is explained in more detail here. Business risk. Business risk is any risk that threatens the ability of a business entity to achieve its objective, which can usually be stated as the objective of maximizing profit or maximizing wealth. Anything that threatens this objective is therefore a risk that profit might be lower. In extreme cases, it could mean a risk that losses will be very large and the going concern status of the business entity might be called into question. Business risk can be divided into two categories. 1. A risk might have a low probability of happening, or if an adverse event does occur, the resulting loss might be small. Where the probability of loss is low and the severity of the loss could be low, the risk can be regarded as acceptable. The cost of control measures to reduce the risk would not justify the benefit from the low risk. A business risk is an applicable risk when the financial impact of the risk could be high. For applicable risk, management should decide on a suitable plan or strategy for managing the risk. The chosen strategy might be any of the following. 1. Reduce the risk by introducing more internal control. 2. Transfer the risk, for example, by insuring against it. 3. Avoid the risk entirely by withdrawing from the business operation to which the risk relates. 4. Accept the risk and take no action to reduce it or transfer it. Business risk and financial statement risk. For the auditor, the significance of business risk is the impact that it could have on the financial statement. Most business risks increase the likelihood that the financial statement could be materially wrong. Some business risks can be linked to specific financial statement risk, such as the risk of 1. An understatement of bad debt or the allowance for doubtful debt. 2. Overstating the value of inventory, where net realizable value is less than cost. 3. Overstating the value of a non-current asset, tangible or intangible, due to failure to recognize impairment. Some business risks do not create any specific financial statement risk, although the risk might ultimately lead to going concern problems for the business entity. Audit risk and financial statement risk. Business risk is risk that management must deal with. Audit risk is a risk that faces the auditor. It is the risk that the auditor will give an inappropriate audit opinion when the financial statements are materially wrong, that is, misstated. Audit risk follows on from financial statement risk. The auditor should therefore assess the financial statement risk as a better The auditor should therefore assess the financial statement risk as a step towards assessing the audit risk. Business risk could lead to financial statement risk. Financial statement risk affects audit risk. Audit risk results from 1. Inherent risk. Risk of a misstatement where there is no internal control to prevent it. 2. Control risk. Risk that existing internal control will fail to detect or prevent a material misstatement. 3. Detection risk. Risk that substantive testing will fail to detect a misstatement. You may be required in the exam to identify the main audit risk in a case study. Within the case study, there may be inherent risk. Risk from weaknesses in the internal control systems, and even detection risk. For example, there might be only a short amount of time and limited resources to perform the audit. It is probable, however, that most of the audit risk will be identifiable as financial statement risk. The types of risk to consider will include the following. 1. Risk of overstatement of revenue or other income. There may be some risk that revenue has not been recognized in accordance with the requirements of IAS 18 revenue and is overstated. This risk will occur when customers make staged payments. For example, staged payments for contract work, or pay deposit in advance. For example, customer bookings for holidays. Revenue should not be recognized until the goods or services have been provided, not when the payment is received. Two, risk of overstatement of current assets. For example, there may be some doubt about whether amounts receivable will actually be recovered. A company may fail to make a sufficient allowance for irrecoverable amounts, and when this happens, receivables and profits will be overstated. Another example may be the risk of overstatement of inventories due to the timing of the physical inventory count or the procedures used in the inventory counting process. Risk of overstatement of non-current assets. There may be a risk that some non-current assets are overstated in value when there is some reason to suppose that impairment has occurred. For example, impairment to a building due to fire or flood damage. Risk of understatement of liabilities. There may be a risk that some liabilities are not fully stated, particularly provisions. There may be no provision in the financial statement when it would be appropriate to make one, and so reduce profits and increase liabilities. It is also possible that an exam question includes a scenario where the company makes a provision for the cost of repairs to fire damage when the losses were insured, but ignores the amount recoverable through the insurance claim. In this case, profits and other receivables would be understated. Risk of understatement of operating expenses. As a general rule, there is usually a fairly consistent ratio from one year to the next between elements of cost and sales revenue. For example, the ratio of administrative expenses to revenue and the ratio of sales and distribution costs to expenses are often fairly consistent from one year to the next. Some changes may occur, but not usually large changes. So for example, if sales revenue is increasing but the ratio of administrative cost to sale is falling sharply, this could indicate a risk of understatement of operating expenses. Risk from accounting estimates. The auditor should check accounting estimates carefully. These rely on management judgment, and when estimates are a material amount, there will be a significant risk of misstatement. Failure to comply with the requirements of specific accounting standards. An exam question may provide details about the accounting treatment of items that are the subject of specific accounting standards, such as contingent liabilities, deferred tax, share-based payments, and related party transactions. You may be required to discuss the risk of misstatement or non-disclosure due to a failure to comply properly with the requirements of the accounting standards. Example: financial statement risk. Zama, a limited liability company, manufactures high-tech computer-controlled equipment for use in other production industries. Its directors and senior managers are also the company's shareholders. On 1st July year 7, they accepted an offer from a U.S. corporation to buy Zama's own manufacturing equipment and technology, which is protected by patent rights. Management notified their employees, suppliers, and customers that Zama would cease all manufacturing activities on 31 August year 7. All the factory workers and most of the employees in the accounts and administration department were made redundant, and the same was duly completed on 31 August. Most of the employees who remained in employment with the company after 31 August were made redundant from 31 October year 7. However, the company retained a small head office operation consisting of the chief executive officer, the marketing and sales directors, the chief accountant, and a small accounting and administrative support team. This head office unit will continue to operate for a few more years until the company's operations are wound down completely. Before the sale, Zama operated from 12 premises. 8 of these were put on the market on 1 August. 3 of the other premises are held on leases that will expire in the next 3 to 5 years. Under the terms of the lease agreement, none of these premises can be sublet and the leases cannot be sold. A small head office building will continue to be occupied and used until the lease expires in 3 years' time. Zama accounts for all its tangible non-current assets at depreciated cost. All the products sold by Zama carry a 1-year warranty until 31 August. The company sold extended 2-year and 5-year warranty, but extended warranties were not offered on any product sold from 1 September. Zama sold its products through national and international distributors under 3-year agreements. Zama also had annual contracts with its major suppliers for the purchase of components. So far, none of the distributor or supplier has initiated legal proceedings against Zama for breach of contract. However, some distributors are withholding payments from Zama on their account balances. awaiting settlement of the large penalty payments that they claim are now due to them from Zama. Required, using the information provided, identify and explain the financial statement risk to be taken into account in planning the final audit of Zama in respect of the year ended 30 September, year 7. Answer: tutorial note. There are some points that you should note about this question. For answering examination questions on financial statement risk, 1. The question refers to financial statement risk. Any comment about general business risk will not gain marks in an examination unless you link them directly to financial statement risk. The question asks about financial statement risk in relation to the final audit of Zama. This means that general comments about financial statement risk or comments about financial statement risk that are not relevant to Zama would not earn you any marks in the examination. It is particularly important when discussing financial statement risk to ensure that the risk you identify are specifically linked to the financial statements. For example, Zama manufactures high-tech products. A business risk associated with this is that inventory might quickly become obsolete. This means that there is a financial statement risk that so inventory might be overstated in the financial statement. It is important in answering an examination question on financial statement risk that you should identify the financial statement risk, not just the business risk. The implication for planning the audit is that audit work should be directed at testing for a possible overvalue of the inventory due to obsolescence. Suggested ideas for a solution. The financial statement risk that might be identified are set out in the table below. The left-hand column identifies the words or phrases in the case study that should enable you to identify the risk. Keywords or phrases in the case study: financial statement risk. The keyword: manufactures high-tech computer controlled equipment. Financial statement risk: the company operates in a high-tech environment and inventories might be subject to obsolescence. Therefore, inventories in the financial statement might be overstated. Keywords: offer from a US corporation to buy Zama's own manufacturing equipment. Financial statement risk: this will affect the way that items are presented in the financial statement. Profits or losses on sales must be disclosed separately. For example, keywords: cease all manufacturing activities on 31 August year 7. Financial statement risk: financial statements should therefore not be prepared on a going concern basis, but on a different basis, such as a breakup basis. Keyword: made redundant. Financial statement risk: if redundancy payments have not been paid at year end, provisions for redundancy payments will be needed in the financial statement. Keyword: small accounting team. Financial statement risk: this may increase errors in processing accounting transactions towards the end of the year. Segregation of duties as an internal control might have been affected. Keywords: 8 premises were put on the market on 1st August. Financial statement risk: this will affect the way that the premises are presented in the financial statement. as assets held for sale. Keyword: leases that will expire in the next 3 to 5 years. None of these premises can be sublet and the leases cannot be sold. Financial statement risk: full provision should be made for this onerous contract in the financial statement. This does not apply to the head office building, which is still being used. Keyword: warranty: provisions will be needed in the financial statement for these warranties. Keyword: national and international distributors under 3-year agreements. The financial statement will need to include a provision for costs associated with breaching these agreements. Example: business risk and financial statement risk. Fitkeeper, a limited liability company, operates 12 fitness centers around Nigeria. The facilities at each center are of a standard design, and each center contains a heated 25-meter swimming pool, a sauna, a gymnasium, and a fitness lounge. Each center also provides supervised childcare facilities. The day-to-day operations of each center are the responsibility of a center manager, who is required, however, to manage the center in accordance with strict company policy. The center manager is also responsible for preparing and submitting monthly accounting returns to head office in Abuja. By law, each center must have a license to operate from the local government authority. Licenses are granted for periods of 4 years and are renewable at the end of each 4-year period, subject to satisfactory inspection reports from the inspecting authority. The average annual cost of a license is 95,000 naira. All customers of the centers are enrolled as members. Members pay a 1,500 naira joining fee plus 800 naira per month for peak membership, or 400 naira per month for off-peak membership. Fees are payable annually in advance. All fees are stated to be non-refundable. One of the fitness centers was closed between May and August in the financial year just ended, after a serious accident in the sauna involving chemicals. The center was reopened at the end of August, but head office management issued an instruction to all the fitness center managers that the sauna facilities should be shut down until further notice. Head office also issued the fitness center managers with revised guidelines for the minimum levels of supervision for childcare. This followed complaints from some dissatisfied members to the local government authority. Center managers have been finding it difficult to provide the additional supervision specified in the revised guideline, and some of them have recommended strongly that the childcare facility should be withdrawn. Each center operates early morning fitness session for members that run from 7 to 8 on 4 days each week. Each center has had problems with late arrivals by staff, and many members have complained strongly that they have turned up for sessions that were shortened in length or did not run at all. Training staff is costly and time-consuming, but staff retention rates in the fitness centers are poor. In addition, staff turnover rates among the center managers are also high. Most leavers complain of excessive directions imposed on them by head office and by company policy. 3 of the fitness centers are expected to have run at a loss for the year to 31 December just ended due to falling membership. FitKeeper has invested heavily in building a hydrotherapy pool at one of these centers with the aim of attracting members who are past retirement age. Completion of construction is behind schedule and costs to date are far in excess of the original budget. The pool is now expected to open within the next 2 months. The company has experienced cash flow difficulties in the current year. As a consequence, head office management have decided to defer by at least 1 year the replacement of gym equipment in most of its centers. Required: A. Identify and explain the business risk that should be assessed by the management of FitKeeper. B. Identify how each of the business risks identified in A may be linked to a financial statement risk. Answer. Tutorial note. You should approach a solution to this question in 2 stages. 1. Identify business risk. Note that Part A refers to business risk relevant to FitKeeper, so comments about the audit risk will not gain any mark in an examination. 2. Having identified a business risk, consider the impact of this risk on the financial statement. You should comment on the financial statement risk associated with the business risk you identified in Part A, so introducing different risks in Part B will not gain marks in an examination. Suggested ideas for a solution. The business risk and financial statement risk that might be identified are set out in the table below. The left-hand column identifies the words or phrases in the case study that should enable you to identify the risk. Words or phrases indicating a risk. Standard design. The business risk indicated. Operational risk is increased by standard design of each center because a problem with one facility at one center is likely to be repeated at all the centers. Financial statement risk indicated. Asset values might be affected. For example, non-current assets might be overstated if they have been impaired by lack of use. E.g. sauna, see below. Asset impairment has probably not been recognized. Words or phrase indicating a risk. Each center must have a license to operate. Business risk indicated. An operational risk exists because a center cannot operate if its license is withdrawn. Financial statement risk. Each center license must be accounted for properly, that is, capitalized. Words or phrase indicating a risk. Fees are payable annually in advance. Business risk indicated. Financial risk is increased by payment in advance because cash has to be available to fund services later when they are due. Financial statement risk indicated. Deferred income must be calculated correctly in the financial statement. Words or phrase indicating a risk. Serious accident in the sauna involving chemicals. Business risk indicated. Serious accident may prompt investigation by the local government authority, leading to fines or penalties or loss of license. Financial statement risk indicated. Provisions should be recognized for any fines that might be pending. If any center license is affected by such events, the license may be impaired. Words or phrase indicating a risk. Revised guidelines. Business risk indicated. Compliance risk, that the fitness center cannot meet the new guidelines. Financial statement risk indicated. If failure to comply leads to punitive action by the local government authority, it may be necessary to make provision for fines or penalties. Words or phrase indicating risk. Many members have complained strongly. Business risk indicated. Risk that falling membership will continue. Financial statement risk indicated. Fees payable in advance are said to be non-refundable. This might be incorrect, and a provision might be required for refund of fees. Words or phrase indicating a risk. 3 fitness centers are expected to have run at a loss. Business risk indicated. Risk that more centers will become loss-making. Financial statement risk indicated. Possible need to consider the going concern status of the company, or at least to test the fitness centers for impairment as cash generating units. Words or phrase indicating a risk. Construction behind schedule and cost to date far in excess of budget. Business risk indicated. Risk that the new hydrotherapy pool will not attract the expected new members. Financial statement risk indicated. The value of the asset should be considered. There might be a loss of value due to impairment even before it has opened for use. Words or phrase indicating a risk. Differ by at least 1 year the replacement of gym equipment. Business risk indicated. Risk of more customer dissatisfaction and loss of members. Financial statement risk indicated. Risk that depreciation might be charged for equipment that is already fully depreciated. Subtopic 3. Materiality. Section 3.1. General Principles. The IASB's framework for the preparation and presentation of financial statements states that information is material if its omission or misstatement could influence the economic decisions of users taken on the basis of the financial statement. ISA 320. Materiality in planning and performing an audit deals with the auditor's responsibility to apply the concept of materiality when planning and performing his audit. The revised ISA makes it clear that materiality depends on the size and nature of an item judged in the surrounding circumstances. It is important to appreciate that the assessment of materiality is always based on the judgment of the auditor, applied to the circumstances of a particular case. There are guidelines on materiality, but no rules. Materiality is relative. Materiality is a relative factor. What amounts will be material in the financial statement of one company may not be material in the financial statement of another. Example: an unrecorded sales invoice of 10,000 is unlikely to be material to the income statement or statement of comprehensive income of a multinational company with revenue of many millions of dollars. However, it would probably be considered material to a small company with annual revenue of, say, 300,000 naira. Despite this, such an error must still be considered carefully even in the context of a large company, as one error could indicate the existence of others which could in total be material. Section 3.2 Materiality Thresholds. In order to deal with materiality on a consistent basis, most audit firms set their own materiality thresholds. Their audit staff are trained to use these thresholds to measure whether or not an item is material. Materiality thresholds vary from one firm to another, but will typically fall within the following ranges. Revenue 1% to 2%. An item of revenue is material if it is at least 1% or 2% of annual sales revenue. Pre-tax profit 5% to 10%. An item is material if it is at least 5% or 10% of reported pre-tax profit. Total assets 1% to 2%. A balance is material if it represents at least 1% or 2% of total assets. The danger of materiality threshold is that they are used simply to measure whether an item is material, without considering important other factors as well. Other factors that the auditor should consider in evaluating materiality may include the following. 1. The nature of the item involved. The values of some items in the financial statement are more subjective than others and depend on estimation. The more subjective the item, the more flexible the auditor should be in assessing the materiality of possible misstatements. The auditor will have to take a very different view on materiality when considering a warranty provision, which is a subjective estimate, compared with the approach taken when auditing share capital, which is capable of precise measurement. 2. The significance of the item. So items may be insignificant in terms of their monetary amount, but may nevertheless be of particular interest to the users of the financial statement. An example might be bonus payments to directors. 3. The impact of the item on the view presented by the financial statement. A small and apparently insignificant error or omission may be material if by correcting it, a reported profit is converted into a reported loss, or the correction significantly alters the trend of profit, growth rate in profit over the past few financial years. Section 3.3 ISA 320 Materiality in Planning and Performing an Audit. ISA 320 requires the auditor to apply the concept of materiality when planning and performing the audit and when evaluating the effect of misstatement on the financial statement, and therefore on his audit opinion, covered in a later chapter under ISA 450, Evaluation of Misstatements Identified During the Audit. At the planning stage, the auditor must determine materiality for the financial statement as a whole. As discussed above, this is often set as materiality thresholds. If lower thresholds are required for some areas, for example, directors' remuneration, this must also be set at this stage. The auditor must also set what ISA 320 refers to as performance materiality. Performance materiality recognizes the fact that if all areas of the audit are carried out to detect all errors or omission under the overall materiality level, that objective could be achieved. But when all the individual immaterial errors or omissions are added together, overall materiality could in fact be breached. Performance materiality is a way of taking this risk into account and will be set at a lower figure than overall materiality. There may be one or more performance materiality levels, as the level could vary by area. As the audit progresses, the auditor must revise materiality and, if appropriate, materiality for particular areas and performance materiality. If he becomes aware of information which would have caused him to have initially set different levels, had that information been known to him at the time. Documentation must include details of all materiality levels set and any revision of these levels as the audit progresses. Subtopic 4. Computers in auditing. Section 4.1. Introduction. Computer systems affect the audit process in two ways. 1. The auditor may use computers to perform his audit work. 2. The client's accounting system may be computer-based. If so, the auditor will need to consider the controls that are in place for the system and whether these are effective, and whether to use computer-assisted audit techniques, that is CATs, to do some of the audit work. Each of these should be considered at the planning stage. Section 4.2. Using computers to perform the audit. It is unusual for members of an audit team to take laptop computers with them to the client's premises for use with the administration, documentation, and performance of the audit assignments. Laptop computers may be used for tasks such as audit administration and control, for example, preparing timesheets and audit work programs. Audit planning work, for example, for risk and materiality assessment, preparing audit working papers, analytical procedures, including holding on file a record of statistics and financial ratios for the client for the previous years, sampling software if appropriate. Using computers for the audit may also allow managers or partners to review the audit work that has been done without having to visit the client's premises. Members of the audit team can email papers to managers or partners back at the office. This saves time that would otherwise be wasted by senior managers and partners in traveling to and from the client's premises. Controls over the auditor's computer system. When the audit work is performed largely on computers, the auditor must have suitable controls in place. Essentially, these are the same controls that should apply in any computer application. Controls should be in place to ensure that client's data remains confidential and cannot be accessed by an unauthorized person. Audit work held on computer file cannot be lost. An audit trail is created for the work the auditor has done to assist the audit review and control process. The program operates in the way that they are expected to.